that, I think I'd like to pass on the conversation to Dev, and Karan has mentioned that he'll be joining us in a minute or so as well. Thank you.
Thanks, Anubhav. And so I'm just going through some of these questions. I have a question here, the last one from Vivek Lat. There are many early stage companies who have either built a good product or good tech, which may be valuable to many other companies, either for technical or strategic fits. However, such deals, okay, the question just disappeared. Interesting. Oh, here you go. However, such deals are not big enough for investment bankers or M&A professionals to put their hands into. How do such companies find a potential buyer? Great question. Bankers and brokers themselves have a business to run of their own. And so there's a minimum size of deal that many of them think about, and it's a different minimum size depending on the banker. I'd say in India, we've come across actually a whole range of bankers who can take up all sorts of sizes, even the smallest size deals. You'll have to search a bit for them if you want to, and ask your advisors, other founders. They'll connect you to a few of these folks, and just talk to them to see if they can give you good value and their time, and if they'll be incented to help you. Having said that, if you can't find a banker, that's not the end of the world. You probably know best who would find value in your company. Draw up a list, figure out how to get through to them, and start contacting them. Also be prepared, and in that document again we talk a little bit about what you can do to prepare to talk to these potential buyers, and know what you are. Are you an acqui-hire for these companies? Are you a company that's a going concern and independent on its own, and therefore you're looking for more value creating sales versus value preserving sales? Know what you are, and that'll help you engage with these companies. It's also important to know who the potential buyers are. Karan, when he comes on, will talk about some of these buyers and what they're looking for, especially the larger buyers that Avendus works with. But you'll be surprised, a lot of smaller funded venture-backed companies that have enough capital are looking for acqui-hires to progress their roadmaps forward. So they're looking for technical teams that may or may not have built the product that they're looking for, but they may just be looking for technical teams that can join their company and then build out whatever's on the roadmap. In the US, 15, 20 years ago, we used to say, if you're going for an acqui-hire to sell your company and you have engineers in the Bay Area, you value your company at $1 million an engineer. And it turns out that math at that time seemed to work in many cases. I don't think that's the valuation you'll see here in the acqui-hire side of things. It'll be lower than that. But think about the engineers and product being the main thing you're selling and valuing that. Again, just talk to advisors, lawyers, even your accountants. Various people will have contacts with some of these buyers and can help advise you. So that's that question. I have a question from Ayush. M&A as well is a long process. Plus, on the due diligence front, there would be a slowdown in the traction, maybe some accrued liabilities in the books and some compliance issues, even though the business is quite well built and scalable. What are your thoughts on these practical issues? My thoughts on this are, having been through several investments of mine that didn't work out, that had to go through a sale process, is there's always some messiness, but identify them and go fix them. And be transparent about them to your potential buyers. You don't want to go halfway through a process and a buyer finds out that you've got like double the number of liabilities that you were reporting you had. That sort of derails these deals, as you would imagine. So just be transparent. If there are problems, that's not a surprise to anybody. Nobody's expecting every company to be perfectly buttoned up, but make sure you disclose those and you act to eliminate those liabilities if you can. There'll always be accrued liabilities, payables to your Facebook and Google, payables to your landlord, and so on and so forth. That's not a surprise at all. But just have it written down, be prepared, have a data room ready on Dropbox or somewhere that you have folders and you've populated these things, your financial statements to the extent you have them, your customers and contracts, your cash balances, your sales pipeline if you're a B2B company, your MIS, whether you're B2B or B2C, the basic things that you would imagine anybody would ask for to get to know your business. The bios of the founders, links to your website, links to your product demo if you're a B2B company, any IP in terms of patents or umbrella patents that you file, all of that, just list anything that could be valuable, have in a data room. Your lawyers and accountants can help you, tell you exactly what needs to be there, and you prepare it in advance and go from there. The question here from Arjun Vikas is M&A activity likely to be higher versus funding activity in the next 1 year? That's a tough question for a couple of reasons, Arjun. One is that M&A activity in the last few years has been fairly anemic in India. If you put aside a Flipkart type transaction, Flipkart Walmart type transaction, or a Make My Trip IBO type transaction, the number of M&A transactions, high value transactions, have been small. But as we come into COVID and beyond, maybe that picks up. I think the sense I get from talking to M&A advisors in the Bay Area over the last couple of weeks, as well as in India, is that this quarter is likely to be quiet while people figure out just how to survive and sort of get their wits around them as to what's going on. But next quarter onwards, M&A activity, especially in the Bay Area, might get quite frenetic as companies need to start either raising capital or finding a home for themselves, and valuations drop. So the market caps of companies come down, and they become much more attractive to large buyers. Just to give you a sense, the universe of large buyers in the US that are themselves worth $20 billion or more is a good 20 companies or so. And for $10 billion or more, there's a whole lot more companies. So there's a good 50, 60 companies that could potentially be buying if they find value in the market. And so I think next quarter onwards, potentially the corp dev teams of those companies could start getting active. So M&A activity right now in EMEC could pick up later half of this year. Funding activity, I think we've all read enough articles. I think this quarter is going to be, much lower than last quarter. Last quarter, I think we got through most of it without an impact. This quarter is going to be pretty tough. The next quarter, I would say the next 6 months, like I said before, advising our companies to assume no funding for the next 18 to 24 months and make their current cash last through that. So that's an indication of how active we think the funding markets could be. When it comes to funding, also the bar is going to be much higher. Where the mindset, I think in the last 5 years, was a growth mindset, growth at all costs, with less focus on quality of revenue and quality of earnings. I think now the focus will be less on growth at all costs. Maybe slower growth is fine, but have high margin revenue, have high quality earnings, move faster towards profitability than you would have a year ago. I think people are looking for that, as well as scale. So subscale companies will be at a disadvantage. The bar is higher for what scale means in terms of revenue. There you go, Karan. Hi, Karan.
Hey, Dave. Finally, I managed to hop on.
All right. I've been, just to let you know, I've been answering the questions on the Q&A. I've gone through 5 or 6 of those, but I'll loop it back to you now to sort of go through the sort of market environment in M&A. There's even a few questions on that. What is the M&A activity going to be like in the next few quarters, in your opinion, relative to what it has been in the past for Indian startups? And then also, who could potentially be doing the buying over here? What sorts of companies and what would they be looking for? So I'll leave it up to you to take it from here.
No, perfect. Thanks. Thanks everyone for holding on. I think there's some issue. Zoom was firewalling me to join in. So I think maybe to begin with, if we kickstart, some background is, what we're seeing, especially in this topic on how we should look at M&A and consolidation. in this market environment. I think there's a why, these are pretty unprecedented times in our view, especially because of the uncertainty both in terms of outcome and in terms of net impact, and the period over which this could really continue. So especially for the Indian economy, the recovery could be at a more gradual pace, and the intensity could be high. And for the startup ecosystem, it obviously poses multiple challenges because most companies, even some of the larger companies, do not budget for this kind of an impact, where revenues could drop down, so dramatically and pretty much to zilch. And also that puts a big challenge in terms of the burn rates, especially on the fixed costs and overheads that these companies have, vis-a-vis the cash reserves that they could be, having. And for VCs, they could be in multiple situations across multiple companies. So it becomes challenging to really support those multiple companies, which actually could be potential winners also for them. So our view is, while the entrepreneurs and the investors are really working on internal facing activities, curtailing different kind of cost burns and elongating their cash runway, it's also equally important to look at from a more external view and connect dots. And there could be opportunities to collaborate closely with other market participants, with other investors and entrepreneurs. And as they would have outlined, I think that's in these times, some of these activities could be seen in a very different way. And we could explore opportunities to either consolidate the market between different companies, and also look at opportunities where teams could come together. So the key mantra here really that one should look at is value protection, and then value creation. I think that is a critical aspect to focus upon. And if you see from an M&A perspective on how we expect for the next few months things will shape up. See, in India, on the tech sector historically hasn't been the most active on M&A. If you see, last year we had around $600 million worth of M&A transactions, while the financing value was almost 10 to $12 billion. Even over the last 5 to 6 years, if we leave aside the Walmart and Flipkart transaction, total M&A activity in the country has been, on the tech side, has been around the $4 to $5 billion mark. The bigger transactions obviously being Flipkart, Walmart. We've seen consolidation between Koi, Vivo, MakeMyTrip. Flipkart has gone and acquired Myntra and Jabang over the last few years, or a recent consolidation of Uber Eats and Zomato. And then some consolidation in the mobility space with Ola and Taxi Ashore and so on and so forth. So it's not been as aggressive, and maybe it's got to do with the evolution of the sector, because bulk of M&A and consolidation gets driven by on the domestic side between local incumbents and local leaders. And till now, we didn't have as many large players. Liquidity in the market was a concern. Now we're seeing the currency grow, both in terms of cash and stock that some of the market leaders have. We have close to 30 odd unicorns now, and at least 100 odd companies in the $300-400 million to $1 billion valuation range. So we have local companies which are sitting on good currency, both cash and stock. And I think that is very critical in the market to drive that liquidity, where you could see either market consolidation or M&A. So that is always critical, because in these times we expect the global cross-border M&A activity will lag behind domestic M&A and consolidation activity. So I would say people who are on ground here, who are able to assess the risk-reward equation in a better way, which are going to be domestic kind of companies today. I think that's where over the first wave are really going to come in from those kind of companies as compared to cross-border, because both in terms of deal-making dynamics and understanding of the local nuances in this kind of environment, we believe the first set of buyers or acquirers could be more domestic. So I think that's a kind of a background, and maybe I can take in some questions. So so I think one of the questions I'm seeing over here from Abhinanda is, given market conditions, the buyers would be stretched to preserve cash. How do you think about stock versus cash deal, and how will existing investor target should reach and react to that? So I think my perspective over there is, yes, you're right. Buyers would like to preserve cash. However, at the same time, this is also a good opportunity for some of the larger players to really augment their position. It will really vary from company to company. Companies where businesses are still tracking well. If you see, these could be sectors like education, edtech, gaming, digital content. I think over there, if they're sitting on good cash, they should look at both cash and stock deal. At the core of this, the industrial logic of a combination should be solid enough, and you would end up obviously looking at a relative valuation as to what the right kind of swap ratio should be there between companies. And I think these are opportunities where you'll see a lot more stock plus cash, and that's the best way to approach it. So relative valuation would come into play. What kind of swap ratio should someone really look at?
Karan, we had a question earlier from Kanwaljit Singh here that said, is there a way that VCs can create some forum or platform which can facilitate M&As, especially for smaller companies, which I think a lot of the audience here might be? What would you advise them to do there? There's no platform that VCs have like this, and it would be tough for us to do that because it's our companies that we would be biased towards. But anything that you would suggest that the smaller companies can do?
Sure. I think one of the things that have started to happen over the last week or so, when we're engaging with some of the mid-sized and large-scale companies, they also believe that there's some high-quality early-stage companies or teams in the market, and they don't have access to them. I think the best way to approach this could be, either through ecosystem players like us or other VCs who engage. I think engagement between VCs and ecosystem players, advisors like us, should increase in this time, where we could pretty much aggregate some of these high quality ideas and really share these with some of the bigger companies who are actually being very open to use this opportunity to both acquire as well as acquire early stage companies. So there is, as these companies themselves have been able to put in place their VCPs, they're now really engaging with us to scout out high quality early stage companies that they could take on. So we're very happy to facilitate some of that. So through VCs, you could drop in a brief about your companies, reach out to us through the VCs or directly as well, and we are happy to try and connect these dots and get some engagement with potential acquirers.
Karan, I'll put you on the spot here. How are they supposed to get in touch with you or Avendus more generally? Is there an email address you can provide of somebody or
Sure. Sure. So I can share my email here. So it's Karan.Sharma, first name dot second name @avendus.com.
Okay. Be ready for a deluge.
Yeah, happy to help out in these times. I think everyone is collaborating closely, and we could use this opportunity to really help companies as well as the companies, the larger ones.
Got it. I'll pick another question from here. And I'll just draw from some others where people said, please differentiate between B2B SaaS and sort of more consumer type companies or other domains. So here's a question, keeping that in mind. Considering the current forecast and market multiples show a more distorted picture in terms of valuation, how would buyers go about benchmarking valuation? I'm assuming they're talking about. This is from Shreyans.
Sure. So I think today you have to obviously benchmark the valuation basis the last kind of normalized month, which could be February for most people. I think those are the kind of numbers those are the underlying metrics on which they should peg a value. Now in this environment, once you're able to fundamentally look at that value in this environment, certainly people will expect a sort of a market uncertainty discount or a liquidity discount. However, those discounts, if they have to think about, should be applied on those metrics and those normalized numbers. There's no way talking about current March or April numbers in this kind of a period. And also some of the ways to structure some of these discussions could be yes, you get into a little more discounted scenario, but yes, there is some sort of a structure to claw back or have an upside sharing in terms you're able to deliver, deliver whatever value you promised. In terms of M&A, this could be some clawbacks, it could be some performance-based kind of incentives, or it could also be some ESOPs as part of the new combined entity, which has some trigger points. Could be value creation at a consolidated level as well. So I think there's some creative structures that one could pursue. However, from an underlying metric, it has to be the last normalized months and some bit of liquidity discount depending upon the situation that each of the companies in. Cash gets valued as cash on both sides if in case it is a swap or a relative valuation and there's a no cash merger.
How have multiples done in the market between February and now? What has the compression been in SaaS or commerce or any consumer sort of area?
I would say a few data points to compare, pre mid-March to now. Very few transactions have closed post mid-March, and bulk of those transactions were in the making. If you see across the board, including some that we have closed, they were in the making for some time. The companies are solid companies. They have decent cash, so there were no renegotiations or any of those things. So very few data points where completely afresh transactions have been valued now. I think some of this will unfold in terms of multiple compression over the next couple of months. It is a little premature at this stage. However, investors that right now are saying that we're open for business, they are certainly looking at some value buys. So obviously you can't compare it to what's the situation in the public markets. Markets are obviously corrected in a very significant way. However, there would be some expectations on some discount. So I would say a little premature at this stage, Dave. We need to see how the next couple of months play out. But the expectation is there for investors, especially who are sitting on dry gunpowder, to look at opportunities in a more.
My view on that front would be that at least on the funding side, the earlier stage a company is, the further away from the public markets you are, and the less you're likely to be, the valuation is theoretically likely to be impacted by public market valuations. The more you are a growth stage company, closer to, scale and to potentially going public, the more you're likely to be affected by, what's going on in the public markets, at least in my opinion. And so I'd say to the smaller companies that might be attending this webinar, don't automatically assume that valuations in your seed or Series A should go down. But also don't assume that they'll stay where they are. I mean, it all depends on the situation and the circumstances and the sector that you are in. What we're also likely to see is smaller round sizes. And so again, you have to make do with less capital than you otherwise would have thought of having in a sort of a upmarket scenario. Karan, there's a question here on who are likely buyers in India by sector. What would cause them to buy?
Sure.
You said earlier that there haven't been that many companies at scale, and then mentioned 30 unicorns and 100 companies just before that. Who's a buyer likely to be? Like who anyway has bought other than Walmart and Flipkart?
Sure, it's I would say till recent times, except for a few categories. So we have seen some sectors being highly vibrant on cross-border M&A. These have been on the payment space. At least 25 cross-border M&A transactions have happened. Be it acquirers in Europe, US, they've been fairly active. So what it means is wherever getting entry into a sector, there are significant entry barriers. Be it getting local licenses, having pipes into different banks or payment kind of networks. There's value to that, and that's where the cross-border works beautifully. And payments, most of the global guys have been very, very active. PayU has gone and acquired 3 odd companies. We had seen Atos acquire a couple of them, MasterCard, Visa, PayPal, all have taken their sort of first bets, larger kind of bets in India, either investments or acquisitions. And similarly, we see even Japanese guys fairly active over there. So payments is almost like both. By payments, I not only mean the consumer payment side of it, even B2B payments and tech side. So that has been a vibrant kind of a market. SaaS, again, I think that is now is the time where companies have started to scale. It has been for most of the global buyers, scale is the threshold is critical. It becomes very challenging for them to go and acquire anything which is less than at 15 million ARR. Acquire that company, integrate that, so just risk reward and the effort is not worth the while. However, now we start to see good amount of companies, even as SaaS, was scaling well beyond 10, $15 million kind of an ARR. And that is where I do expect in SaaS, M&A activity should increase. The other theme, Dave, which has been a challenge till now has been in e-com. I do believe now we have some of the larger aggregators in place. You see entertainment or gaming, say a Bookmash or a Dream11, or you see e-com, you see Flipkart, or the next set of folks, be it a Lenskart, Nika, some of those Westcry, some of those kind of companies. So you see now the aggregators scale up in an interesting way. Now they're also sitting on good amount of cash. They have good currency. Most of them, especially the vertical focus guys, are also close to profitable or already profitable. And now they will be looking at say direct to customer brands, or they would be looking to augment some of the technological kind of capabilities, be it in AR, VR, be it in how can they really enhance the modes that they have. So some of this stuff has started to pick up more in the recent periods, because these companies have evolved very rapidly in the last year to 2 years to be reached this position. And we expect now some of the M&A activity to increase. Some of this would be in the works already, and maybe some of this will start unfolding in the next 6 to 12 months. We will see domestic M&A, domestic consolidation activity to pick up significantly in the next 6 to 12 months, just by looking at the activity that is happening in terms of their deal engagement.
Thank you. I see a bunch of people raising their Zoom hands over here. We are not taking verbal questions over here. If there are questions, please type them into the Q&A button or tab that you have on your device. Next question here was from Animesh Pandey. Apart from pure play M&A and carve-outs, what are the other kind of strategic partnerships that startups can think of as options? Are IP partnerships, IP licensing arrangements, especially for B2B SaaS startups, an option that carry less risk for the buyer and probably require less time to execute? I'll just start off the answer here at least, and we've written this in the document on acrants.in as well, which is that at least one way I've seen these relationships get going with strategic partners is through an investment route, and not necessarily through an actual investment, but through engaging with the investment teams at these large corporates, where they get to know you without sort of thinking about it as an M&A thing. And as they get to know you, they start to bring in their product teams and other teams to evaluate you, and the company gets to know you, and multiple companies get to know you without sort of the pressure of an M&A transaction and all of that. So I've seen that as an interesting way to get entry into some of these larger companies. And obviously, if some of them result in investment, that is also a different type of transaction that would eventually end up going to M&A in some cases. But Karan, I'll leave it to you. Are there other types of structures that people can look at?
Sure. So there we've seen, especially the global corporates, most of them actually have a preference to have a business partnership with maybe some very small kind of equity kicker attached to it. Most of them prefer to engage with companies first with a strategic partnership where they end up investing behind that partnership, which means they really invest behind the go-to-market or specific tech development related to a specific business that these companies will be looking to conduct. And this is sort of a convergence of both the business development and the corporate development teams. And that is an interesting way, because it really lays the ground for larger partnership to come in. They're able to justify that this is a partner which has been able to align well with us. Their technology really stands up to where they believe should be the right kind of a level. There is sync between the business teams, and that gives a good ground for them to pursue either larger financing transactions or even complete M&A. We've seen players like say in payments. Networks like Visa, MasterCard played very well. Similarly, we've seen the same playbook from folks like Microsoft. Either they do it through their accelerators or some of their grant or venture funds. We've seen the same situation with other ecosystem players like Google, who prefer to have partnerships going before they and have a business case before they make an investment, because for them an investment and acquisition is really not for a economic gain alone. It has to drive more strategic value. So these could also be times to really get some of these kind of things rolling.
Yeah, I mean, I'd say, I just add to that and say specifically to the IP licensing type relationships, I personally haven't seen those happen that often, for various reasons. At least I think so. One is that an IP licensing arrangement means that you are going to become part of somebody else's product roadmap, and syncing up your roadmap and another company's roadmap, especially in the tech sector where things change so often, is a 12 to 18 month endeavor just to get a contract in place, and then it's another 12 to 18 months to launch that product, and then the revenue starts flowing to you 36 months, 3 years out. So these are very long-term, sort of long drawn-out processes that don't net you any cash in the near term. Generally speaking, there's always exceptions, of course, but that's what I've seen.
Absolutely. So we are seeing some exclusive product rollouts.
Okay.
I think the closest that we've seen for a defined period of time.
This would be more D2C, going through an e-commerce aggregator type of thing.
Even B2B, to say launch a product for say merchants, SME merchants or anything, which is a very specific product not available in the market, where you're able to give a head start to your partner. And which again, in those ones, specifically the equity kicker comes in place.
Yeah.
Because you're able to do this and help us create a moat for our target B2B client set, and hence we're willing to invest as part of the overall partnership.
Yeah. We have a question from Diksha Datta, not necessarily M&A related, but let's address it. It's got a bunch of upvotes. How are founders supposed to have reserves for the next 6 to 8 months suddenly now? What are the measures they can take, considering it was not a practice they've been following in the past? What are the kind of strategic partnerships that can save them? Her question is specifically for SaaS companies. I mean, I can kick this off.
Sure.
I'd say having reserves only for the next 6 to 8 months, I'm not sure that was sort of common practice. Prudent to have reserves for longer than that, especially in SaaS. Many of the financings that we do in SaaS, here at Lightspeed at least, the companies budget for that cash to last them a couple of years, 18 to 24 months again, not 6 to 8 months. What are the measures they can take? I think a lot of the expense in SaaS, at least we've seen, is in the go-to-market. And so, the first thing a lot of companies do is, I'm not sure it's the right move necessarily, but the first thing they do is stop aggressive hiring on go-to-market, especially if you're selling into the US and other markets where sales resources tend to be slightly more expensive. And you have to, account for a ramp-up time for those sales reps to get to productivity. You can sort of pull your punches on that one and go a bit slower. Also on R&D, not hiring as aggressively or sort of freezing sort of hiring is something that we've seen a bunch of companies do. Once you get beyond, $5-10 million of revenue of ARR as a SaaS company, if you stop growing, you can be profitable. So it's just a question in some sense of with how much of a haircut you want to take on growth. That's my view, at least. Karan, anything?
Sure. No, they're very well articulated. I think from an internal inside-out perspective, purely from an external perspective, it's if you have 6 months of cash today, looking at the scenario, at least three odd months is going to be very difficult for a company to engage deeply with investors if you're engaging for the first time. If some of them have done deep diligence on you earlier, didn't decide to pursue for whatever reason, maybe some of those threads you should pick up right now, and again focus on adding onto the cash, focus on maybe trying and arranging for say 3 to 6 months of capital could be through family offices, other entrepreneurs, and get creative on the deal structuring. Give not just focus on deep discounts because that could destroy some short term and long term value, could destroy some value on ESOPs, or maybe incentivize them through warrants or other instruments, so that you could have an interim financing at least gives you at least at a minimum a 12 to 15-month runway today to have a fair shot at approaching institutional VCs. Couple of months from now, when at least the lockdown is lifted and there's an opportunity to engage. So I think you have to figure out different pools of capital to elongate that runway, because even in the 6 month period, as you start nearing, if you, as you start eating into 3 to 4 months, you'll see an impact on a team, a lot of uncertainty over there for them, and you could have a flight risk of people.
We'll take a few more questions and finish by 2 o'clock, so 10 more minutes. We had a question here from Ajay Balusu. Any reason why traditional Indian companies like Reliance, Tata, Mahindra, etc. are not more active in tech M&A?
Sure. So we started to see Reliance get active. Reliance has done 4 to 5 odd transactions in the space. Again, in looking at sectors that they believe, they want to augment some of the capabilities, they went on to acquire Savan on the content side, which is a very natural kind of a play. Similarly, they focus on the SME space, acquired a company called Now Floats, and then also looked at education with Imbibe. So they have been fairly acquisitive. And given, I think largely driven by the group's philosophy around geo. In terms of some of the others, we have seen them engage in the ecosystem. We've seen them engage in the ecosystem in terms of evaluating opportunities. Somehow they haven't been very, I would say, aggressive in looking at these things. They have done their own forays in ecom. Most of these groups are not as successful, and maybe they would have committed more capital in some of those organic forays. While the moment it has come to acquiring some of these tech assets or being more aggressive there, I think they've taken a little more conservative stance. We expect that to evolve. We have also seen now some of them will also start seeing to have a more de-risking strategy as very comparable in this environment, to have a strong channel play, offline, online, for some of the big retail kind of guys. They've also understood that tech is something that you have a DNA for. It's not very easy to just build it organically in house. I expect some of these notions to evolve. However, this observation is right. We haven't seen them, the traditional houses being very aggressive. Mahindras have done some investments on the mobility side, on the electric side, but yet most of the people have not been overly aggressive. And I believe some of whatever the kind of event that have happened in recent times, maybe this will this could drive a shift in their thought process to de-risk their businesses.
We have a question here from Suprav Sarang. Post-COVID, in case M&A picks up, which transaction structure may be preferable to sellers? Asset sale, slump sale, or share sale? Karan, maybe you can describe what an asset sale is and a slump sale is for everybody's benefit. A share sale is obvious, buying all the shares of a company, but what are these other two things?
Sure. An asset sale or a slump sale really comes in, wherever the intent is to acquire a part of a business or assets and not really focus too much on the potential liabilities that could come along, either through creditors or employees or other kind of situations. Also varies from the kind of taxation kind of impact depending upon the structure of the company. So some of these are more structuring to address either potential liabilities that could come along in terms of equity kind of a swap. Also comes along whether you want to carry on the shareholders of one company into another, which will be into equity swap for sure. So it all depends upon the structure of the company, potential kind of, is it what kind of situation you are in, what is the understanding of investors rolling into the next set of company, preferences on both sides over there, and the potential, tax impacts over there. our view is that we'll see when it comes to consolidation, which is genuine market consolidation, which is mergers, similar stage companies, similar size companies, or broadly in the same kind of industry vertical, which could be either having an overlap.
Hi, Karan. Are you there? Anubhav, you experience the same thing? Karan is frozen on the screen.
Yes, I experienced the same thing.
Of some of the smaller or younger companies.
He's back.
Karan,
where would
Karan, you'd frozen for about 15 seconds in
Okay.
answering that question.
Okay, so I think the last one I was covering is when it comes to maybe acquiring certain capabilities or teams. In those cases, we'll see more from sales or just a transfer of contracts. So some of those things we'll see in smaller companies. For larger ones, genuine consolidation within the ecosystem, be it horizontal or vertical integration, there we'll see more of equity swaps.
Got it. We have a question from Amit Narayan. Is there one factor you see which could tip the inflection curve towards M&A from current focus towards conserving cash? In other words, perhaps part of this question is also about when is this M&A market likely to arrive? Sounds like, I mean, this had answered a little bit before you joined, which is that this quarter seems to be unlikely much is going to happen on the M&A front as everybody takes stock of where they are and tries to survive. But beyond that, when you think, are we talking even about this year, 2020, or are we talking about 2021? How do you think about that?
Sure. Dave, our view is that, what has happened is it has pretty much impacted the return expectations for investors and shareholders by at least 18 to 24 odd months. And if we go back to the same situation, say, let's take two competing companies, right, or companies in the same space who are deeply discounting against each other, have a lot of overlapping kind of functions. Now, if both of them can really, sail through this kind of a scenario, in all likelihood, 18 to 24 months from now, they'll be again burning cash against each other. Now, because of this unique kind of an event, which is both macroeconomic, impacts consumption, impacts economy, impacts fundraising, valuation, across the board impacts everything. I do believe shareholders, investors, entrepreneurs will see opportunities to improve this entire, return profile or value creation opportunity, wherever it makes industrial logic to really shave off, discounting that two companies could have done against each other, or incentivization in the supply chain that they could have done against each other, or if they're able to achieve profitability earlier with lesser capital and have lesser dilution together. I think some of these things, these thoughts are coming to people's mind, which also collaboration is increasing between the ecosystem. I think one key aspects to any M&A or consolidation is the softer aspects of individual and corporate egos. I think some of those things will normalize. I expect from a timing perspective, these things will start shaping up, and maybe we'll see some activity towards later half of even 2020. I do expect that by in the last quarter of this calendar year, we could see some interesting. At least people will give a fair shot. Some of them might close, not close, but I think people are going to give a fair shot at some of these opportunities, which they might not have given had this event not had happened.
Got it. We'll take two last questions. We have one from Sanya Chawla. Do you see alternative investment instruments gaining traction like convertible notes? Given the market scenario, how are the discounts and caps getting decided? It's more of a funding question, I guess. But
sure, absolutely. So we are seeing convertible debentures being proposed even for late-stage larger companies. The way some of the folks are looking at, they don't want to get into a discussion on what is the valuation or value of a company today. And they want to look at situations where they're able to ascertain that they want a very specific kind of an IRR. So they're looking to put this debenture convertible notes on IPO or exit events with pretty much nominal kind of coupon rates. However, they don't want to be, they want to have these instruments are pretty much, they sit right at the top. So they sit right on the top even of a liquidation preference stack in equity. And even if you raise more equity down the line, still these convertible debentures or debt instruments will sit over and above those future equity instruments, which means to some extent they are think about them as always a senior instrument to anything that you are able to raise. For the companies, they're able to move ahead in a quicker time period, not get deeply discounted today because of what the scenario is, not get into that debate into whether value erosion has happened to them or not, as long as the long-term thesis of value creation and exit hold true. But actually, some of these instruments could be interesting. Now, one thing that companies need to really be very very conscious of is of redemptions. Now, redemption periods could be longer. However, that could trigger a cash outflow event at the end of 5 years, and that is something which again, it doesn't eat into at a personal level, but yes, it could certainly impact company in case their own liquidity position is challenging at the end of 4 to 5 years. These instruments have been fairly common amongst most of the prominent US companies across the board, especially companies that have gone and listed 2 to 3 years since they issued these instruments. So yes, we are seeing some of this creative play now coming into the Indian markets also.
Got it. Two questions that are the same, similar on valuation. How does one determine the value of an acquihire or value just a tech and M&A deal? And how should acquihirers think about valuations in general?
Sure. So some of see it's a again so there's no straight answer to it. Some of the things that we've seen people play out is they look at say a set of people, a team of 10 or 20 people. They look at what should be the market CTC for them, multiplied with a factor. See, it could be a factor that hey, can we actually have this team for maybe 4 to 5 years kind of a value, and then give them that value in terms of ESOPs immediately today, which obviously vest over a period of time. So people, I'm just using these numbers in a more free way, but that's the way they end up looking at that. This is CTC of this group of people that they're looking to acquire. Let's upfront that CTC in terms of ESOPs in our company, and then obviously we'll let it vested out over a period of time, and then top it up basis certain performance benchmarks or milestones that they're able to hit. So there are some approaches that people take. Certainly, they're not ascribing any value to the business that you were running and you were creating.
Is there any number you'd give here, Karan? X per engineer or X per anything else? I know before you joined, I'd mentioned 15, 20 years ago in the Bay Area when I used to live there and I was a founder there. The number that used to be floated around was $1 million per engineer. Now that's a very different time, and things have only gotten more expensive since then, I'm guessing. But is there any such benchmark here?
We've seen anywhere between 2 to 5 years of CTC
per engineer or per whoever
for the team across the board. So, that's why for the team.
2 to 5 years of CTC. Okay, that's interesting.
Yeah, usually they're looking at the team coming together, because individually hiring those 1, 2, 3 people. So if it's a 20-member team, was a CDC of that 20-member team, and obviously benchmarking to market, and then putting in anywhere between a 2 to 5 year value to that CTC, and then giving it in ESOPs in the incoming company.
Okay, truly the last question. We're at 2 or 3, but this is the top question right now from Gaurav Bubna. What do you feel about M&A activity from large Chinese buyers? Are we seeing any activity from them? I know earlier you'd mentioned, we shouldn't expect much of cross-border activity for the time being, but what about China?
See, most of the cross-border that we've seen has been with US and Europe on the tech side till now. Fewer Chinese acquisitions because also of around certain sensitivities in some sectors. I would say it is yet to be seen. At least I would say it will take time. It will take some time before we see that intensity pick up. We'll see we see more interest in some pockets. Education being one of them, edtech being one of them, where we see good interest. Content being another one. We need to see some of. We also need to factor in how the government and the entire geopolitical thing comes in place over here, we'll see increased activity. At a core level, when we are engaging with investors and strategists over there, there's a strong intent to diversify into the Indian markets for sure. There is strong, very, very strong intent. Now, somewhere, at least in the last year or so, we have seen a gap in the intent and final execution of that intent. Maybe some of this could accelerate in some time. However, as I mentioned, there are some other external country level aspects that would need to be addressed, specifically in some sectors. But yes, we will see increased activity.
Got it. I think we're clean out of time over here. There's 33 more questions and we've answered 20 odd. So we'll clearly not get to all of these, but thank you so much, Karan. And Anubhav, I'll turn it back to you to close it out.
Sure. Thanks a lot, Dave and Karan, for taking out the time. I hope it was a very productive session for everyone.